Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist at OptionsPlay, and we're going to have a discussion on trading credit spreads and short puts and short calls. And I even have a bonus strategy for you today during volatile market times. And in general, we're talking about navigating the trade wars. And this is going to be about a 1 hour presentation. 45 minutes of it is going to be a PowerPoint presentation. I'll be flipping back and forth between my PowerPoint and the OptionsPlay platform. I'm going to show you how you can utilize that platform when you're picking out the strategies. But I want to put a little bit of terms and conditions behind what strategy that we want to focus on. And I'll tell you this, with the VIX, well, now we're a little south of 30, but kind of hanging around that 30 range for a long time, the volatility index, and also just volatility in general, especially in the tech stocks. There's been some interesting short spreads, if you want to get bearish in general, to look at it. In other words, we're going to talk a lot about the fact that you can capture a little bit more premium than you used to be able to in a less volatile marketplace. And that's one thing that we're going to focus on today. So before we get too far along, I have to let you know that we're here to empower you as far as education is concerned with OptionsPlay. And we do these events every Thursday. We always try to pick a very timely topic to do, but every once in a while we just talk about the Greeks or pricing or something very simple and straightforward. So we appreciate that you share this with your friends, social media, pass the word around, because this is free for all every Thursday that we do for OptionsPlay. And also we have a disclaimer. We're going to be showing some real prices today. They're not meant to be recommendations. Past performance is not a guarantee of future results. So just keep that in mind. Now, this gives you access to a 30-day free trial for OptionsPlay. You'll get all the tools that I'm going to show you today. All you got to do is hit that little, pick up your phone, scan that, and you can sign up and you'll get that information. Or you can just go to optionsplay.com/sign up. All right. Last thing that I want to mention before we get too far along is that Tony, every Monday morning, Tony Zhang, the chief strategist at OptionsPlay, talks about the markets. This is available. You can register by just clicking that, and we'll keep you abreast of all the situation every Monday morning. A really good, really informative. 1 second, I'm sorry. There we go. Want to make my pointer a little bit bigger. Every day, or every Monday, Tony will talk about just different stocks that we are looking at. And based off of that research, we do something inside the OptionsPlay platform that is called the Daily Play. So if you register, we'll keep you aware of it. You don't have to attend, of course, but if you click that button, every Monday morning, you'll get an alert about a half hour before the event starts that it is happening. So feel free to do that also. All right. So I'm going to start with the credit spread scenario. Now, when I've usually talked about top income strategies, we usually like to look at selling puts to buy stocks and selling calls to sell those stocks after they've been purchased. That's called the wheel strategy. And I've recently did a seminar on the wheel strategy. But what I think in this marketplace is the most interesting trade are credit spreads. And in particular, if you're trying to get bearish on an underlying, well, I don't want to try to get too advanced right away, but the way the volatility is skewed makes for some very interesting credit spreads for the amount of premium received versus the width of the spread. So I'm trying to run before I walk. So let's just get into the simple concept of what a credit spread is. Oh yeah, and I should mention that we do have the ability to ask questions during the event. You do see a Q&A box. If you'd like to participate, click on that Q&A box and ask the questions there. The chat box is open for all. You can talk amongst yourselves if you would like, but the Q&A box is what I'm going to try to focus on if we have any questions throughout the entire event. So hit the question mark, all right? Because that's the Q&A box, and that's the one that I'm going to focus on during the event. Simple strategy. Okay, income generating strategy for a mild directional view on a stock or an ETF. We're going to kind of focus more on stocks today. The stocks are some of the more interesting scenarios that I've been talking about. Forgiving strategy with higher probability of success. You want the market to either stay where it's at or go lower on the call side, or stay where it's at or drift higher on the upside. So you have a couple of scenarios where you do okay with this strategy. You will have limited and known risk, but you also have limited reward. And we'll talk a lot about that reward relative to the risk in this event in particular. So we have an example here on Boeing. This is the OptionsPlay platform. When this example was taken, it was this year, I think. Boeing was at 177, so it wasn't that long ago, because well, it would have been before their earnings date, which was in January, so somewhere back then. It was trading at 177. Boeing's been beaten up, but everything else has kind of been beaten up since that time. And if we look at that trade, here is what we've determined has been an optimal credit spread. And we've built tools inside the OptionsPlay platform to try to look for this scenario. Now, this is a general scenario. If you're trying to trade on earnings, which I'm going to show you a trade that we put in our OptionsPlay daily play this week, actually this morning, on an underlying stock. And I'll talk a little bit more about how you might want to approach it if you're going to trade just on earnings. But in general, if you're doing a spread trading portfolio, we've determined that your target expiration date is usually going to be about 45 days out. That's where that's kind of on the decay curve, where you have the time premium can help you if you're wrong and the market goes against you. Doesn't hurt you as bad, but it also is a decent amount of time decay that it will profit you in a shorter period of time. So what you're getting by going out 45 days to expiration with our credit spreads is you're getting something where it shouldn't hurt you that bad if you're wrong, but it should help you quite a bit if you're right. Now, obviously, the trend in this day and age is to do zero DTE options and just trade based off of that a one-day move in the underlying stock. And you know, they're not for the faint of heart. If you do those type of trades, you get movement and things are going to happen. But if they go against you, they go against you really hard. And if they go with you, they go with you really hard. So we're trying to look for something that is a happy medium. By going out further in time, gives you a chance, if you did want to adjust it, gives you a chance to get out of the trade. Those little type of things. If things are going with you, might as well ride the trend. If you got it wrong, say you were sitting on a support line or a resistance line based off of your strategy, and it breaks through that level, well, this gives you an opportunity to get out, whereas if you're looking on zero DTE options, it's a little bit harder to do that. All right. So in this one example, we're looking at selling a credit spread. So let's set up the credit spread and talk about what this is. 45 days out to expiration, and here's the trade right over here. We're going to sell, and usually, inside the platform, let's put it, we're going to select something that's close to the money. And the biggest reason why is that selling at the money option contracts brings in a lot of premium. It's where, quote unquote, all the juice is in the options trading world. So we're going to sell something that has about a 50 delta, and then the platform's going to decide about something that has about a 25 delta. But more important, and this is what the platform is focusing on more, is that we're going to collect about a third of the width between the strikes. So in our instance here with Boeing, and part of the reason why this is an example is that the math is pretty straightforward in that we have a put vertical spread. That means that you are hoping that the market goes up, which obviously didn't happen in this scenario here, but Boeing is at 177, selling something close to the money, right? So the stock is at 177. The trade is to sell the 175 strike put, go down 10 points, and buy the 165 strike put. So this means that you are buying the right to put stock to somebody at 65. That's your protection. That's your hedge. You are taking on the obligation to buy the stock at 175. The market is at 177 right now. You hope that it just stays there or drifts higher. And if that happens, time decay is your friend on this trade. Now, obviously, you have a bullish scenario. You're not just trying to look at something way out of the money, right? Like selling the 170 strike put and buying the 160 strike put, shifting it down 5 points, and then just playing, well, I'm going to bring in a little bit of premium. I have a high probability of success, and I just hope that it really doesn't come down against me. If I'm doing this, I'm truly bearish on Boeing, and that's going to be our outlook. And because I'm truly bullish on Boeing, and because of that, I'm going to sell the option contract that has a lot of premium, which will also help limit my risk on that credit trade. Okay. So for example, here, $3.77 is the midpoint for this trade, or $377 per 1-by-1 spread. And that's how we want to enter it on the trading floor. We want to send this to the floor I'm never going to enter a spread and just say I want to do it at the market, right? So here we're looking for a net credit of $3.77. Usually you're focusing on, right in between where the bid and ask would be on that trade. And so at least a third of the width of the spread. And this is what the system is going to do for you. But if you have $3.77 divided by 10, 0.37, right? 37% of the width of the spread. A little bit higher than the 33% on the width of the spread. So it will show you that trade, but this is a solid scenario of if you're doing a credit spread situation, right? This is the standard. This is the optimal is the right word, right? The optimal credit spread that on a just standard basis, trying to generate income and trying to earn money off of the credit spread on whatever underlying you like. This is on the bull side of things. We'll look at some things on the bear side because, well, I guess recently in the marketplace, we've had a little bit of a bounce back, but the bearish spreads have been a little bit more interesting than the bullish ones. All right. Okay, so I have a few questions that are in here. Yeah, I love zero DTE. I love them too, but they are definitely a different trading vehicle. Inside, so let me look at and see if I can address any questions. If you have any questions in general on credit spreads, let me know. Oh, someone's saying thank you for the Intel trade. That's a trade I was going to look at. I obviously haven't seen what has happened because I'm getting ready for this event. So I'm assuming that so far has been a good thing. I posted that. We'll look at that trade when we get into the platform. Will this be recorded? Yes, it will. It's going to be available to you. And if you want the slides, there is a link to the PDF in the description. So if you go down and you click on that, you can actually get a link to the PDF of the slides. Well, we'll have it in the description. We don't have it right now. That's simple. But it will be available right inside the YouTube platform. All right. Do these mean, given your credit spread comments, how is our Tesla trade doing? So Tesla is moving against. So at this point in time, we're probably on Bob. We're going to look to try to get out of the Tesla trade. It's a scenario where the fundamentals weren't strong, but you can never trust yourself as far as what Elon Musk might say and try to generate some income. And it's gone against us. So we'd have to close out that trade. And that was 100% an earnings trade. Now, and I also want to realize, because I see comments from time to time that if you're trading credit spreads and you're doing this over and over again, right, and you're trading in particular around earnings, if you're getting them right, if you're getting them correct, 60, 65% of the time, you're doing extremely well because you're flipping a coin if you're trading around earnings. It's a different time period, but you still hope that you do the fundamentals, you still do the math that's behind it, and you decide how to close out that trade. So yeah, I'm sure Tesla has gone against us. Somebody mentioned Intel. Intel's probably going with us, and I'm not really sure. But Bob, as far as the Tesla trade is doing, it's not doing well. So you would close it and you would just get out based off of the rules. How to get the slides for the presentation? All right. All right. So here's the 3 simple rules. If you want to stick to the format, the 3 simple rules that we look for a credit spread and exiting a credit spread is we're going to exit most of the time. You have 2 scenarios where this trade would work out, in particular in the Boeing one, right? If the stock stays where it's at or drifts a little bit higher or drifts a lot higher, you have that scenario where you can win on that trade. So our first rule is that you want to have more winners than losers, obviously, and you have a scenario where you have a higher chance of that happening. You don't need the market to move with you in order to make money. It's a neutral trade. We're going to exit if we get 100% of the max gain. So the max gain is the net credit received. In our Boeing example, it was $3.77. So you're looking at about $7 and let's say 20 some cents. And that's where you'd want to close. Double the premium that you received is the exit point on the loss. Now, when you do a credit spread, you have some room beyond the strike too. So the fact that we brought in a premium of $3.33 means that our break even is going to be lower on our short put spread in Boeing. That's going to happen on that trade. So I have not only can I make money if the market stays where it's at, if it even drifts a little bit lower, I still have a chance to make money on the trade. If it drops a lot lower, well, yeah, then I got a situation. You know, there can't be 3 different ways that you win on a trade. But that is the way that we always approach this. You're going to probably have more. The math says that you should have more winners than losers. And you don't want to let this go against you too much, too hard. So we're going to get out if we're at 100% of the loss of the premium that is paid. Now, if neither rule 1 or 2 is satisfied, and you're dealing with the 45 days to expiration trade that we set up, if we get halfway through the position and nothing is really happening, we just want to close that position. That means with a 45-day trade, day 22, day 23, we're going to look to just get out of the trade, about half of that days to expiration. Obviously, this rule doesn't apply on 0 DTE, right? You're just trading it in one day and either it's going to happen or it's not. And this is the standard rule for the setup that the OptionsPlay platform will look for and try to, try to come up with the scenario that we're going to look for and try to apply. That's the word I wanted, was apply. All right, so fully automated credit spreads. We'll look at a few of these trades, and I'm going to run over to the OptionsPlay platform to talk about it. But literally inside the platform, and if you do sign up for the 30-day trial, this is available to you. You see credit spreads. Credit spreads will be highlighted here. That will show you both puts and calls. It will highlight if they're bullish. It will highlight if they're bearish. Bearish call, bullish put. In this marketplace, a lot of things are leaning a little bit bearish. So you're going to probably see more bearish trades than bullish trades. In this marketplace back then, you saw more bullish trades than bearish trades. All right, so credit spreads that can generate more than 33% of the vertical risk. Very liquid underlines, execute at or very close to the midpoint. That's what your goal is. Never enter a credit spread at market. You're opening yourself up, giving up too much on bid-ask spreads. Aligns credit spreads with our technical analysis direction, which we're highlighting here what the direction is on the underlying. All right, let's get out of this, and we're going to run up to the OptionsPlay platform. Okay, so to start with, what we want to do is just go to ideas, and it always usually defaults to technical ideas as far as the trades are concerned. We're going to go down and go from technical ideas, hit the little down arrow, and go to credit spreads. And we pull up a credit spread. One of the first ones that comes up is PayPal. And PayPal is an interesting underlying. It's bounced back a little bit. Let's take a peek at the chart. And we see where some support and some resistance lines have came in. Down to the downside, we've had a little bit of a move up, saying at this point in time, we're hoping that we can back off a little bit on the technical aspect of it. We're leaning bearish on this trade. If I click on this, this is saying that we can bring in premium. The premium isn't quite, it's going to be close to 50%, but not quite there. But this is a 6-point wide spread. So ideally what we want to pull in, if we do this trade, is about $2. So it's highlighting here that PayPal is up today at 64.77. We're looking to sell to open one PayPal June. Notice it's going to highlight 43 days out. Call vertical and bring in $2.08 or $208. So we're going 6 points wide. Yeah, it's going to be right at 33. 208 divided by 6. We're looking at 35% of the width between the spreads. Shows us where our break even is at, right? Even though PayPal is at 64 in this scenario, 64.77, we're selling the most at the money option contract. And then our break even point is going to be 67. So if the market does drift down a little bit on our trade, we still are profitable. We still got 3 points because we're bringing in a big enough of a net credit that it gives us a small pillow to land on if the market does continue or does go down or go against us in that position. So on this vertical call spread, if we're doing this, we want the market to stay below that 65 level, and our risk is contained after we get up to the 71 level. So right here on our profit and loss graph, we're bringing in that type of premium. Our break even here is at the 67 level, which would be our strike of 65 plus the net premium received on that trade. Now, if you are interested in this trade, we can go and we can click trade, and it will highlight this. If you have a position set up with your broker, you can set it to your broker, or you can add it to a watch list. And I created a watch list just for this event, and you can track it, and you can paper trade these positions if you find them to be interesting. So in this scenario, we're going to go and I'm going to select a portfolio, and the portfolio that I'm going to select is called credit spreads because I named that. If I want to add a portfolio, I can, and I click credit spreads, and then I click add that position. And it shows me that that position has been added into my portfolio. Now, if I go over to the portfolio and I look at this, this is the trade. It shows me where my cost basis was done based off of the midpoint was $2.08. Now, obviously the markets are closed right now, so you can put this trade in after the market hours if you would like to. You're just doing it for your own tracking. And then if I have the position on and I wanted to get out of the trade, if I click on it, it will set up this scenario here where I can just close the position. I can close a leg of it. I could roll the position. But if I click close position in this scenario right here, it will show me the closing trades, right? So we are short the 65. So we're buying the 65 right here. And we are long the 71. So we are buying the 70 or selling the 71 to close. So if I hit close position, trade, I'm sorry. If I hit trade, then we will close out that trade, and it will show you once again, it's giving you the bid, mid, and ask based off of the market prices as of the close today. So, and if I added that position, that would remove this from our portfolio of options. All right, so easy way to track to see how they're working. Let's go back and look at some credit spreads. And you can also look at a watch list too. So if you have watch lists that are set up that are that your own personal watch lists, and you click on those watch lists, it will show you underlyings and give you ideas for credit spreads on those underlyings that are inside your watch list. So we're going to go down, we're going to scroll down in here, and notice that it's also doing XLE is the ETF that tracks energy. And it's saying here we have a bearish call trade that you might be interested in doing on the XLE. So the earnings has, well, energy has had a fairly decent ride up rate recently, and today they did it again. It's up about 1.6%. Here is a bearish trade. We're going 5 points wide, bringing in $2.28 or $228 on a 5-point wide spread. So once again, this marketplace is just real interesting. You're getting more than a third of the premium by selling at the money option contracts. The outlook inside the platform is bearish on both of these instances. We have our support and our resistance in this way. So right here is a resistance level to the upside that the platform is highlighting, and it's highlighting that area down here. And this is why we're ended up doing that trade. So once again, you could click trade and you can add that to your position. IWM is in here. Let's see if we can see anything. Yeah, there you go. So we got a bearish call on NEM, which is Newmont Mining. And we actually had a recent daily play in Newmont Mining that worked out. But this is based off of gold. This is a gold and silver miner, is Newmont Mining. If you click on it, notice it's highlighting 43 days to expiration. And now what I've noticed recently, and then I'll address some of the questions here, is that if you do this trade, we're 4 points wide, and we're bringing in $1.37. On the put side of things, the credit's not as enticing. And it's really because of the volatility and the way that the marketplace is kind of leaning to the downside, that the short call spreads have been more interesting than the short put spreads. But in this instance, we're bringing in, we have 4 points wide, and we're bringing in $1.37 divided by 4. We're looking at a 34%, and it's highlighting probably that, yeah, right down here, 34% premium amongst the widths of the strikes, right? So it's saying here we're going to be selling the 55 strike put and buying the 51. 43% is the premium that we're bringing in. So it meets the criteria going out 43 days. You put the trade on, you can paper trade it, come back, follow that position, send it to your broker if you would like. It would send it directly to your brokerage firm to use their order tickets if you have a particular broker set up that you want to do the trade in. Or you can paper trade them and you can try them out and try to put the rules that we have set up inside the OptionsPlay platform. And you will also get alerts inside your portfolio based off of those rules. You will see an alert feature that will pop up, and it will highlight it right here saying that you have an alert saying that you are at double your loss on your credit spread that you have on your account. So it will even highlight that for you as part of it. All right. Let me see if I can address questions on this, and then we'll go back and we'll look at the wheel strategy. Larry says, send the trade to Thinkorswim. Not at this point in time. We do not. There's Fidelity is available. Other brokerage firms, First Trade, are available. I don't have them all memorized in my head. Exactly. That's more Tony's side of things. But there are a few of them. What does POP mean? Pop. Okay, that's a great one. It's a great question. So let's go back to the ideas. And advanced auto parts, that's an interesting one. Now let's do Newmont Mining. Let's stay within, where this is the technical ideas. But advanced auto parts is interesting, just in general, if we're heading in, if we're going to have hard times ahead of us. Here's our PayPal trade that we initially looked at. Okay, so this means probability of profit. If I look at this, it's saying that I have a 66.75% chance that the underlying stock at expiration will finish below the 65 level. And that's what POP stands for, probability of profit. Another way to look at it too is to look at just the delta of the position. That's going to be fairly close to this number, but delta, delta is a lot of times talked about as probability, but that's not a 100% accurate thing, but it's accurate enough, to try to say that. So this would be somewhere similar to the delta of that strike option contract. And it gives you the probability of profit just by looking at POP. All right, great question. During earnings, people recommend time spreads, iron condors. Which strategy is ideal? Okay, so Rajay, I will look at a time spread, but I'm not doing it for earnings, okay? I don't want to ride it through earnings. What I have attended, that question's a whole seminar by itself. I can't remember if I have one inside the OptionsPlay platform. I've been doing this for so many years. I don't know exactly where I did the seminars, but that talks a lot about time spreads. Ideally, it really depends, and it's horrible to say this, but it really depends on your forecast for the underlying. Right now, if I'm bearish, and we showed that in Intel today around earnings, if I'm bearish on that trade, I'm going to lean towards the credit spreads, mainly because they're just an interesting risk reward based off of the way that the marketplace is. And that may be different when the VIX or the volatility index goes all the way back and is now trading in the normal range, quote unquote, around the 15 level, as opposed to up the 25-30 level, where it's been hanging out recently in that scenario. So there is no golden book of answers as far as the strategy is concerned. What we're talking about a little bit today, you would implement even around earnings. By going out further in time, it helps with the risk. Now, every 3 months you're going to have earnings, so it's hard to try to avoid them if you can, but some people do. Some people say, I don't want to do these strategies around the earnings events. And like if I have an underlying that I don't want to sell, I don't like to sell calls around earnings. Even though you get increased implied volatilities, but if I'm just selling calls to try to generate some income, I want to be cognizant, do I really want to sell the stock, right? And with earnings and selling calls, if the stock gets called away from you, well, there's not much you can do, because you might shoot through your strike, and it's hard to adjust that trade if that does happen. To the 21 days existing. Yeah, Derek, you're saying, so Derek's asking a strategy. God, we got quite a few in here, and I'm having a tough time getting to the next round. But we did recently do one on, the wheel. But let's go back to this. And all right, let's pull this back up. And we do got a question just about 21 days. And that's it. And that is the answer. I just adjusted this slide a little bit to say half, right? So rule 3, neither rule 1 or 2 is satisfied, close the full position at half the DTE. So you're talking about 21 days or 22 days. Yes, I'm subscribing to the way the strategy is set up inside the OptionsPlay platform, and that's part of the reason why. So I guess I could put 21 on the slide if I really wanted to. All right. An anonymous attendee says 100% loss. Why not keep it until expiration in case it reverses? The rule is that we get out at 100% loss, but if you were able to do the trade for $5 and it was a 10-point wide spread, 100% loss would be 10 points. So anonymous attendee, there's going to be times where, yeah, it makes sense to just keep it around, right? Depending on where you got the trade executed at. So that would apply sometimes. I'm not going to close it. If I could sell a 10-point wide credit spread for $5, right? I do not want to close it at 10 if there's a possibility that the max, that would be at the max loss anyways. So if you're fairly close to that, yeah, I can see leaving it and letting it run. But in general, if I'm doing, the PayPal trade was $2 and you're looking at a 6-point wide spread, right? So you'd be closing it out at $4, and then you're saving yourself $2 worth of risk on that trade. And the concept here, anonymous attendee, and I know that's probably not your real name, but the concept here is that if it's going against you, get out, right? In other words, you were wrong on your forecast, and if you're at 100% of the max loss, that probably means that the trend is not your friend. And that's really where the rule comes from and why we're saying it. And it applies itself more to the situation in PayPal, where we did a 6-point wide spread for $2. And if, we don't want to lose the full $4 on that trade, on that position. Fair enough. These are general rules, right? And you do want to try to stick to them. And the platform will help you stick to them. But with that said, in a scenario, well, I guess I don't need to beat a dead horse. If I sold it for $5 and I was able to get that great of a fill on a trade like that, and the max risk is $10, well, I might let that one ride a little bit longer, right? Because the max loss isn't that much greater than the rule that we have, or the width of the spread. Is that fair? All right, I definitely answered that one. I don't know if we're going to get to the extra trade. Okay, so Martin asks a little bit about the options play score. It's really centered around 100, Martin, and you get a green light or a medium light or a bad light, right? So red is bad, green is good, and we got a neutral color right in the middle. And so the options play score is based off of some of this criteria. If you're looking at a 1-day 0 DTE option trade, there is some criteria that's behind it, but if you modify it and you look at it, if you're doing a 0 DTE trade, the platform's probably not going to say this is a great trade for you, right? Because these are the rules that are set up behind it. So it's important that you put the education along with the platform and the math. But it's that simple. The higher the score, the better the platform and the math that's behind it thinks of the trade. Okay, so somebody was asking about under filter. Well, yeah, I guess I knew that we could turn this entire presentation into just about credit spreads, because it's just a real hot topic at this point in time. And all the questions that I'm getting are around that, the credit spreads. Now, somebody asked about settings, like premium versus width. That's the default setting. You can look for symbols, company names. You can even look for implied volatility ranking. Like in PayPal, this is at a 55 level. But these are the settings. And you can also look for earnings, right? If you want to trade something around the earnings date, this will actually sort via the earnings date. And it's highlighting you that the earnings are happening within the time period of the days to expiration. So this little button over here will highlight, do I want earnings? Do I not want earnings if I'm going to do the trade? And then you can decide in your drop down what you want your premium to be. So really straightforward, sort by symbols, IV ranks. These are the ones that are available to you. And we're adding new stuff all the time. As a matter of fact, we have a lot of things that are happening in the watch list here over the next month or so. That's going to be where we're going to make a lot of advancements as far as this is a little bit of behind the scenes information. All right. Man, we have a lot of, I could make this just a Q&A session, but let's not do that. Let's get back to the point at hand. Okay, so now we're looking at the wheel strategy, and I've recently done this, and I use the same example here. And I'm going to actually toss in one other trade if we don't get too far along here. We're right at the 5 o'clock Eastern time hour. So simple rules. We want to identify stocks to sell options on with clear rules as to when to enter a trade and when to leave. Okay, so selling puts is tough in this market. You've been assigned on a lot of things, and so I want to kind of address that in the wheel scenario, because if you're doing this strategy, you usually try to continue to implement it. But if you get down so much, you don't want to continue to buy and trying to catch a falling knife on the way down. So I'm always very cognizant of the option contracts that we're selling on a particular underlying strategy and trying to ladder your buys on the way down. So if you're buying it and you get put to you because you've sold a put and now you own that underlying stock, you need to have the income to be able to buy more. So if I'm doing the wheel strategy and my plan is to buy 300 shares, I'm not going to just sell 3 puts against it, right? I'm going to try to ladder them, especially in this marketplace, to say I'm willing to buy at lower prices on the way down, and then I'm going to be selling calls against them once I put them in. And that's the concept of the wheel strategy. So continuous income, you're really trying to make your money from the premium received, more so than from the capital gains on the stock. And the way that I always would approach the wheel strategy when I look at this strategy inside my own account is I really just don't want to be selling stocks at losses. So if I get put stock all the way down and I'm still happy about the stock, right? I still don't mind owning that underlying stock. A great example is the one that we're going to look at right now, Nvidia, solid fundamentals, that type of stock. But in a scary scenario right now, the news headlines are not behind Nvidia at this point in time, and it all started with the DeepSeek news. But with that said, fundamentals are strong, and I just don't want to be pegged on the stock and get it called away from me at a big capital loss as far as Nvidia is concerned. Selling a put, once I buy it, I got to keep track of where I own it at and then think about selling calls somewhere around that strike. And that's the way, that would be my adjustment to this marketplace, if that makes sense. But here's the concept, all right? So I sell a put and I collect premium. If it expires, sell another put and collect premium. And if I get assigned, I buy the stock, then I sell a call. If that call expires, sell another call, collect premium. Get assigned, I sell the stock, I generate income. Sell another put to try to buy an underlying that I like. It expires, sell another one. Get assigned on the stock, you buy the stock goes down, you get it put to you, you buy it, you have the capital to buy it. Then you sell call and you try to collect premium above and beyond any dividends. You do have a capital appreciation on the upside as far as the call is concerned, but the big thing is to try to think about the premium. And we're doing on the put side of things, oops, I meant to go forward, not exit. On the put side of things, when you're selling this put, here's the concept. You want to acquire the stock. And I know a lot of people that are selling puts just hoping that it will expire worthless, and that's a hard scenario when the stock runs away from you and you don't get put to stock. So the concept and the way that we look at it at OptionsPlay is we want to bring in enough premium that we're okay if the underlying stock runs away from us. But if we're looking at the stock, this is the break even on the stock. You buy the stock outright, unlimited upside, buy it, and if you buy it and it goes down, substantial loss because you own the stock. Well, you sell the put, the stock gets put to you at that strike. So your break-even point goes down because, first of all, you received the premium, and if it gets put to you, you can keep that premium, but you still have all the loss of owning stock, and you still have the max gain here on the upside. You got limited and known upside if the stock runs against you. But if you get put to stock, well, then you have this same line, and hence the dash just moves over, and you have a little bit more of a break even on that trade. And that's the short put. And then you combine that with the covered call. Guess what? A covered call looks just like a short put as far as the profit and loss graph is concerned. But now you own the stock and you're selling a call, and you're saying if the stock goes on up, limited and known upside. You receive that premium, you're lowering your break-even point even more than if you own the stock outright, and it creates an obligation to sell the stock at a higher price than where it's currently trading. All right, so in this scenario, this was a scenario that actually could have happened in the marketplace. We're looking at buying 100 shares of NVIDIA at 103. Target price for the stock was 125 that we had on it. That was our outlook on the underlying. If the NVIDIA at that time was trading at 107, and as you know, NVIDIA went down below that. So if you're buying via limit order, your target price is 103, right? That's where you want to buy it at. With the options contract, we're trying to buy it at 103, but we're going to bring in a lot of premium here. And this was an actual scenario in NVIDIA where you could bring in $5.25. Now that's a real premium that we're bringing in. And instead of put the stock at 103 and having a break-even point of 103, it's 103 minus that premium received, or 97.75. And I can already tell from a lot of the questions that are in here, we have a very astute clientele that is attending right now. And in that scenario, though, this is the general basic concept. I don't mind buying NVIDIA down around the 100 level. I'm going to sell a put saying that if the stock comes down, you can put it to me and I'll be willing to buy it, and I have the capital to buy it. And hence it's called a cash secured put. I'm going to lower my break even, and now I'm going to own the stock, and then I'm going to sell shares against it. All right. So this actually happened. NVIDIA at the time, I rounded up on that one slide to 107, but it was 106.98. And the market did come down to 103. Your break even would be 97.75. NVIDIA above 103 would expire worthless. But here's what's big. You're going to keep 5.37% on that underlying. And this is why I think it's really important that you think about the puts that you're selling, because if NVIDIA runs away from you and it goes up, let's say 10% over that time period, well, you missed an opportunity. And if you sold a way out of the money option contract and brought in $1, well, that was a very small percentage of your capital that you received. You got a glorified dividend on that underlying stock. So what we do at OptionsPlay is we say, we want you to be okay, not happy, but okay that you didn't get put the stock. And our definition of okay is around a 5% premium. Okay. And that's the concept. And that's what our short put scanner is going to do for you, is going to look for things where you're going to bring in about that amount of premium going out 30 days in time, or 40 days in time, 40 to 45 days. Okay, so then in this instance, put the stock, went out and used the scanner to find a call option, and the call option that it was recommending is a lot less premium. Why? Well, you own the stock, and we're going to give yourself some upside. It's usually going to be, and you can adjust it, you can tweak the platform, but in this instance, we're looking at about a 10 delta. And that's saying there's a 10% chance that the underlying stock will get called away from you. In this scenario, it shows you that you were bringing in only about 1% of the stock price. But if the underlying does get called away, you have a raw return of about 9.85% if the stock does run up to that strike price and you actually get called away on your 100 shares of NVIDIA. So you have the return, we're calling the raw return, of just the capital that's received. So now in this scenario, think about this. We sold the put, received over 5% for selling the put. We put the stock, and we sold a call, and we're going to look to receive about 1% for selling the call. We still have upside potential, but right there, we've just brought in over a 43-day period, right? The first option contract was about that, and now this is also about that. In that scenario, we're talking about bringing in 6% just in premium received let alone above and beyond any capital gains you may make on the stock or any losses. So the losses, can also hurt you in this scenario. But this is the concept that's behind the wheel strategy, is trying to bring in enough premium that if bad things happen to you, they will help offset any losses that you may have and add to any gains that you get on any particular underlying. All right, now I've answered a lot of questions. These are things to think about, and I always like to try to think about things like when you might be assigned, those type of things. If you want to get into more detail on that, please go check out the wheel strategy. We did talk a lot about these. But here are the ideas. We have, once again, the short put scanner that's going to scan for things, and you're going to look inside there for, this is annualized rate of return, but this is going to highlight somewhere where you're going to get about 5% on a 30-day option contract. Then you get on the call side of things. We're going to highlight things that are going to come out at about a 10 delta that get you some upside, but are going to highlight things that are going to bring in around 1 to 2% as far as those call options that are concerned. So here's how you do the scanner on the short put. Much different rules than on the short calls, and we went into great deal on the credit spreads. All right, I will answer your questions. I'm saved about 7 minutes of time. Please access OptionsPlay.com if you want to sign up. We try to mesh education along with the tools to allow you to implement what we're trying to teach in all of these Thursday education sessions. So 100% free trial. We don't over spam you. If you sign up for it and you end up not joining us, we're not going to hammer you with a bunch of emails about everything, but just check it out. It's very simple, very easy to do. My name's Brian Overby. Follow me on x.com at Brian Overby. I have a little book called the Options Playbook. It's 100% free. All the education, all the text that is inside the book is at OptionsPlaybook.com. And obviously there's a link to buy that if you would like. All right, so let me go back and try to address a lot of these questions. And I'm probably going to end up switching over to the platform, OptionsPlay.com, which is the main reason why we're here today, right? All right, I'm going to be looking at the questions. And man, I got 50 questions opened. All right, I'm going to kind of work my way up and try to scan through this. Can you explain the difference between POW? Okay, so POW is inside probability of profit, probability of expiring worthless, I think is what we're talking about here. Let me look at a covered call. Pins is an interesting one. Well, Palantir is interesting too, right? Here, let's look at Palantir. That's obviously in the news in this day and age. Strong move up today. Probability of worthless in this instance. Okay, so this is basically telling you what's the probability that your option contract will expire worthless at the expiration date of the option contract. And in this instance, there's a 66% chance of it expiring worthless. And I'll highlight this. This is one of the things, there's kind of a checklist whenever you're doing an option trade. And we're going to highlight, is it good or bad, right? There is an earnings call on May 5th, and that's going to be the case with, we're about halfway through the earnings season. But on May 5th, there's an earnings date. Be aware that there is. And you can see that up here. We even highlight that it's going to be in the PM. That means it's going to be after the close on May 5th. Palantir is going to be announcing earnings. Spread and liquidity. It will highlight if it's not liquid. If it's not liquid, it's going to have a little, once again, exclamation point saying this underlying isn't a very liquid underlying. Be aware of that. And Palantir, we're obviously a very liquid underlying, so it says we're fine. Here's your probability of expiring worthless. Here's your annualized rate of return. So we're giving you a checklist across the board on a covered call position where if you bought this and sold this. All right. I got that, Mario. Can you explain it? Yeah, I did. If you're only interested in 100 share lots, how do you ladder down? Robin, you don't. Here that's the situation. Robin, if I'm only going to buy 100 shares and I don't have the capital to do so, you know what I like to look at, and this just in general makes it simpler. If I have a smaller portfolio and I'm not going to buy expensive stocks, and Nvidia is even an expensive stock at 100, I might look at the semiconductor ETF. ETFs are usually try to make them very affordable to buy 100 shares. XLE, XLF, like right now, an interesting ETF is the financials. They got beaten up with the talk of a possible recession. Odds have gone up according to Goldman Sachs and JP Morgan. But in this instance, the XLF is trading at like $48 in the financial world. And the XLF has Berkshire Hathaway, which is one of the most expensive stocks in the marketplace, but it's a lot less. XLE. So that would be my recommendation, Robin. If I am only looking to buy 100 shares and I'd like to get into Nvidia, try to find an ETF that is trading at a decent price that would give you some of that representation. And that is an issue with covered calls and protected puts. I usually like to at least be able to buy two round lots, right? So XLF is a great example. Bank of America's in there, like JP Morgan is an expensive underlying, and I might not be able to do buy 200 shares of JP Morgan, right? But I can buy the XLF and it has representation in JP Morgan. And that's the best answer I can give you. Okay, so Alex asks about getting assigned on the stock, and how much lower will you allow the underlying stock to go? Well, I'm going to sell some calls against it on that position. And the concept of the wheel strategy is that you're going to bring in enough income to try to protect your gains. Now, here's where my warning comes in, Alex, and I'll apply it directly to your question is, if the market just keeps going down and I keep trying to sell calls against it to try to offset some of that, I just don't want to get pegged where I have a huge loss because the underlying stock ran up so high and it went straight through my strike, and now I have a big loss on the stock and I didn't get a ton of premium on my options. That's where my concern is on the trade. But the concept is that I'm going to bring in enough to help offset the stock, and hopefully I did my math and my outlook and decided that that I like this underlying stock and that I can hang with it. Now there's not a great answer to it. If you're losing money, there's no golden book of answers on anything. Sometimes you do just want to toss the hat in and say that I want to get out on this underlying trade. And I'm sure a few people have felt that way with Nvidia. But fundamentally, Nvidia is still a strong position. Still like it. And we still actually have it inside our list as far as our research is concerned that Tony puts out every Monday morning. There, it's a great segue for that. That is still a part of the research list and the research report. No, James, you're taking it two steps further. So James' question is, if you're dealing with a stock that runs, why not use some of the put income to purchase a credit spread or get some upside if it continues to run? James, now you're getting complex. We're trying not to make it complex. You want to do some stuff like that. Yes, I have done, in particular around earnings. Okay, James, I've done earnings trades where you sell a put spread to pay for a long call. That simple, right? So you go out, and in that instance, I'm going to go a little bit out of the money because I don't want to be assigned on the put spread, and I'm going to see how much of a credit that I can bring in. and then I go out of the money and buy a call option. Now that's a very speculative trade, and you're going to do that on an underlying that you feel confident is going to go up. You can't really get more bullish than that. I mean, buying a call outright is less bullish than selling a put spread to pay for that call. But that would be the scenario, James, where I would use something where you're doing this. But that is not what we're talking about today, right? That's a completely 100% speculation scenario. Would you consider starting the wheel strategy with a credit spread in case the markets tank? Barry, yeah, you can do that. The problem is that, Barry, if you're using a credit spread and a short put credit spread or a put vertical spread, if you're doing that, it's hard to get that 5%, right? So the goal here is that we're trying to do the 5%, and that's what the actual platform is looking for. And I'll click on it and go down to there and go at short puts. The platform is looking to try to bring in a 5% scenario if the market runs against you. And wow, in this one, you're looking at 11% on Snap Tools, which obviously a very risky underlying. Reddit is an interesting one. A lot of volatility in that, and that's, you know, a new thing that just came to the marketplace. See what happens on short puts on Reddit. Yeah, another 10%. So the premiums are amazing. So, well, this is a great example, Barry. Maybe I would do it in Reddit. If I can receive the raw annualized rate of return at 10%, and I can take 5% of that and buy a put as protection, that would be a scenario where I would consider it. And I just got lucky by clicking on Reddit that had a 10% chance. So if you're going to trade them on a volatile underlying like Reddit, yes, that would work. Yeah, John, can OptionsPlay help me out put together a list of stocks desirable to own? Yeah, first of all, we do have a technical analysis sort right here, and it usually defaults to that, and that will help you with that. But check out Tony's event. That is more based on stocks than on options. The daily play, we're grabbing stocks from the research report, but every Monday, Tony is putting together a watch list of stocks that he thinks are good and bad. And he takes the time to do all the fundamentals, all the math that's behind it, add a little technical analysis. It is a very, I'm actually really, I mean, bluntly, I'm very impressed with how good Tony does with that and the amount of time it takes him and the effort that he puts in to finding stocks. So definitely. And that is right here, John. And I'll answer a few more questions, but that goes all the way back to this little link right here. If you click on that, that's going to be that research, then it's updated. And if you do the trial, you're going to get an alert right up on top that says, oh, by the way, we have new research that comes out, and we post it and update it every Monday and then also on Thursdays. Okay, so anonymous attendee brings up a really good position, real good scenario. And this is happening more and more. And I did a recent seminar called Option Trading Landmines, but anonymous attendee said, I tried to hold a credit spread that was at 100% maximum and I got assigned. Okay, so I want to see if it comes back. It's at the maximum. Why close it out? You know, you got a chip in a chair. Hopefully the market will come back and I'll be able to save some money on a potential hard loss that I have. But that person got assigned. Now don't panic if you get assigned. If you have a short whatever side, you are protected, but exercise your other side of the coin. Like, in other words, somebody exercised and annoyed you, you exercise someone else and get rid of the stock or buy the stock, depending on what you have to do if you're long or short, but use your options for what they were intended. It was a limited risk strategy because you're long one option and short one option. And it's always, in most of the cases, except for time spreads, but in most of the cases, there's obviously an options world, there's a chance. If you are as long as many options as you are sold, you have limited and known risk on the trade. Okay? Now, there are, exercise and assignment problems, and that's part of the option trading landmine. And if you put that in, I don't think there's a lot of people that use that search term, but option trading landmines talks specifically about your scenario that you brought up, anonymous attendee. All right, guys, everybody that's out there, we still got 39 questions available. Yeah, I'll answer this last one because it's I like to do a lot of butterflies around earnings. So I like butterflies, Alex, and it really, once again, it does depend. I like a butterfly if I'm going to do a shorter term trade around earnings than a credit spread. So I like credit spreads for a little bit longer term. I like butterflies for shorter term, and that would be my way to look at it. If I'm going to do a zero DTE, like Amazon always announces on a Thursday, that means the options contracts that expire on Friday have 1 day to live. I'm probably going to do a butterfly and not a credit spread. All right, but we mix it up. There's no golden book of answers as far as what strategy you do all the time. All right, everyone, that's it. Thank you so much. Please check out Tony's event. Once again, my name is Brian Overby. Follow me on x.com. My handle is @BrianOverby. And check out my book, OptionsPlaybook.com. So with that being said, I hope that all the options that you buy finish in the money and all the ones that you sell finish out. Thanks for tuning in.